I've been doing more of these videos where I go through 3 cheap stocks to consider below 15 times earnings. A lot of you enjoyed such videos. You asked me to do more of them, maybe once a week. I'm trying my best. I tend to find these stocks through a screener called FinViz. I just screen for stocks below 15 times earnings, and I put a technical level of 0 to 10%, pretty close to 52-week lows, as these stocks tend to have bad sentiment, and I try to select them based off the stocks that you guys suggest me and just one you ask me about in general. As a lot of you maybe are wondering about my opinion on certain stocks, what do you think about this stock, that stock. So I'm going to try to review 3 of them in the video, trading below 15 times earnings. I've seen a lot of people get excited about these stocks. Some of them could be value traps. Some of them could be amazing buying opportunities. So far, after 3 videos, I only concluded that one of them was a buying opportunity, which was Crocs. It was trading around 7.5 times earnings, and it has been going down. A lot of you asked me about it, but the stock recovered. Now it's sitting at 94, it's up over 8%. Massive recovery, over 22% in just pretty much a week and a half. It has been pretty stellar. But I have another one that could be something like Crocs here in the video. I'm going to share it for the last stock, so I really hope you enjoy this. The first stock that a lot of you asked me about and is trading below 15 times earnings is a stock called AbbVie. This is a healthcare pharmaceutical kind of stock, now sitting at $138 per share. It has been through this range pretty much since 2022. A lot of you love it. A lot of dividend investors really like the stocks, and I actually used to own AbbVie years ago, but I personally, try to stay away from pharmaceutical companies because you never know when they get a lawsuit, when they get sued, something happens, maybe something with Pfizer or something like what happened with the 3M's healthcare division, and you're sitting at something 30 or 40 billion dollars worth of lawsuits you have to pay, and the stock goes down. So even if you do the perfect valuation model, everything is perfect, if they do get some kind of a litigation lawsuit or whatever you call them, the stock is going down no matter how much research you do on the company. So this is why I tend to try to stay away from them. But AbbVie has been pretty much suffering since they lost the monopoly protection of Humira. Most of you have heard of Humira, maybe you've seen ads on the TV. It's a pretty popular drug that AbbVie owns, and they had some kind of patents and protections on it, and this is gone in 2023. They have more competition, and AbbVie has been a little bit suffering since then. The market has not been too excited about AbbVie after Humira, even though AbbVie have diversified into different industries like Botox and many other places. They did some acquisitions, and they seem to be doing, decently well so far, and these kind of segments are growing revenues fast as Humira used to grow. But still, the market is not too excited, as they were loving Humira. But now the Humira protection is not there. And if we just look at a basic PE ratio, again, I'm going to keep it very short in the video so I can get through 3 stocks within 10 minutes. But if we just look at a basic forward PE ratio, now it's sitting at 12.5 times earnings. Now the historical average over the last 10 years was around 12 times earnings. So there's not much bad sentiment around such stock. And whenever I'm quickly screening a stock and I see no place for multiple expansion, I try to look at the potential estimates for revenue growth or net income growth to see if I can get any return from just EPS or net income growth. And based on the analyst estimates, they're all over the place, around 9% growth in 2025, then 6 and 7%. To me, that's extremely high for a quick valuation. I would take something like 5% as a safer bet. So if I'm taking 5% as net income growth every single year, and I'm looking at the free cash flow yield, which is pretty much if AbbVie takes the free cash flow, does buybacks and some dividends, pays some debt, returns value to shareholder, the free cash flow yield is something like 8%. So 8% and potential 5% from net income growth is something like 13% return every single year. So if I'm quickly trying to analyze AbbVie and see what kind of return I could get, I would see something around a 13% return every single year, which is not bad at all, but it's not the highest return at all in the market. This is not something that personally makes me excited. I think there's much better opportunities in this market, especially as we're taking quick estimates. Net income's all over the place. It's not like stable or like 5% or 7%. It's down down and it's up, and it's just very pretty much it's hard to determine. So for me, AbbVie so far looks fairly valued. It does not look extremely undervalued, like it's the best deal in the world. Nothing like Crocs or anything crazy where it was just too obvious that this stock is cheap. I think AbbVie is fairly valued at 12 times earnings. I see around 12 to 13% return every single year, which for a lot of dividend investors that could be pretty good. But for me personally, I mean, I think there's better opportunities in the market. Now, the second stock that a lot of you asked me about is BBY, which is Best Buy company. This is another stock that's been a disaster. It topped out at $140 per share in 2021. Now it's sitting at $70 per share. A lot of value investors have been buying, BBY, Best Buy, where this is a store in the United States, and maybe they have some in other countries, I'm not sure, but it's mainly the United States, where you could go and buy computers and stuff, and they have some kind of divisions where they can fix the computers, fix your phones, a Geek Squad, I think it is, and it's been a while since I've been there. I mean, most of us order on Amazon or such website. Very few people still go to Best Buy, but some people enjoy going there. But Best Buy faces a lot of competition because you could buy this TV from Best Buy, because you could buy it from Walmart, you could buy it from Costco, you could buy it from BJ's Wholesale Club, you could buy it on Amazon. I mean, there's so many places you could buy this TV. Why would you go to Best Buy? So there's very much a lot of competition. It has been heavily shorted in the past. It still kind of has a little bit of a high short interest. The guidance for 2024 was an absolute disaster. They expect comparable sales to decline between 3 to 7%. Nowhere even close to growing in terms of comparable sales, a decline of 3 to 7%. And Best Buy, I mean, this is the worst retailer to be in my opinion, because it's not something that's a necessity. It's not something like BJ's or Costco or even Ulta Beauty, where women, they go and buy makeup. There's so much competition for something like Best Buy. You could buy this TV everywhere, and they have all this staff inside. Labor inflation is high. Labor is still tight somewhat in the United States. So they're giving them more and more raises. Inflation is high, and they have a lot of theft. A lot of people are stealing stuff from Best Buy. It's pretty expensive stuff to steal from Best Buy. And sometimes they have to put security guards, and that costs them even more money. So it's pretty messed up in terms of the retailer itself. This is not something I would be excited to hold for 20 years. This is something I would look at for some kind of a short-term trade if the market is too pessimistic on it or something like that. And if, again, we look at a basic forward PE ratio, it's around 10 times earnings. The mean was around 13 times, so it is trading around 25-30% below the mean, which is actually great, and it gives me, a little bit more excitement to look in a little bit deeper. And if I look at a quick analyst estimates in terms of net income, it's going to decline massively in 2024 and pretty much stay flat to 2028. And from me knowing the Best Buy model, I would personally believe these numbers. I would very much be shocked if Best Buy grows 5 to 10% net income every single year. I mean, I would be really shocked. It will most likely either be flat or maybe a 1 to 2% growth or even decline. So the net income is pretty much predictable, but we do have a potential for multiple expansion. Now, whenever I see the net income being predictable, I try to look at the free cash flow yields, of forward free cash flow yield based off the management's guidance. It's around 8.8%, which is pretty close to 9%. So 9% free cash flow yield. The balance sheet is not bad at all. So I'm seeing a potential 9% return from the free cash flow yield, a potential multiple expansion. Maybe you could add around 3 to 4% every single year. So in total, again, it's the same as AbbVie. I would see something like 12 to 13%, but I would much rather buy AbbVie than something like Best Buy. I mean, it could be a value trap. Net income can decline a little bit more. There's nothing that can prevent it. There's no floor on the stock. There's no floor on their earnings. It's pretty messed up stock. I mean, I would stay away from it. Personally, I would not try to be a hero with this one. There's so many different opportunities we discussed on the YouTube channel. We talked about them. But again, I'm not too optimistic on Best Buy. I would much rather buy AbbVie in this case. But the third one, which a lot of retail investors have been getting excited about, this is a stock that has some kind of a cult following where the people that love it, they defend it in any kind of way, and there's some other people that hate it. It's kind of like Palantir or SoFi or something like Nvidia. Pretty interesting. And this is Deere & Company, John Deere. Most of you are familiar with the brands. They own those tractors you could see in construction places, but mostly in farming, all kind of farming tractors and engines and products and all these kind of things. If you're betting on something in the United States, I mean, you could bet on John Deere. They're selling a lot of those trucks. I believe over a 60% market share worldwide, 60 or 65%. I have to look at the numbers again of the tractors for farming have been pretty much from John Deere. They have a pretty good reputation, pretty good equipment. We have a few people in my own group that are in farming, their family is in farming, and they told me about these trucks and they like them and they keep buying them. And they don't have much competition in this space. So this is pretty interesting in terms of John Deere. The stock has struggled to break out of 448. This has been pretty strong resistance lines. Every time the stock touches 448, it goes lower. And it's pretty cyclical in general in terms of the business model. It's not predictable at all. You cannot predict farming and such trends. Maybe some analysts can, but it's extremely hard to value, extremely hard to predict. And now, the company is reporting, not too optimistic numbers, you could say, especially on the last quarter. They have posted a 1% decline in net sales and revenues. Net sales was down 4%. Net income was up 5%. EPS per share was up 11%. The company does a lot of buybacks, which I'm going to talk about. This is one of the reasons why you should be potentially investing in something like John Deere. I mean, I like the company. I like the management in general. They also revised their outlook lower for fiscal year 2024. They expect around 8 billion of revenues and 8 billion of net income, which would put them somewhere around 12 times forward earnings. 12 times forward earnings, it's at the lower end of the cycle. You could see the company is cyclical. So it gets a multiple expansion, people get excited, and then the multiple contracts. And it goes up, and it's just kind of the semiconductor industry or any kind of cyclical industry, a lot of lumber stocks. You can see the same exact chart. If you look at price to book, or if you look at price to earnings, it goes up and it goes down. It's very hard to invest in these companies, very hard to determine. But if you look at the 10-year chart of John Deere or the net income of Deere and Company, I mean, it's been pretty stellar. It has been steadily growing despite the company being in a highly cyclical industry, as the company has made a lot of acquisitions. But now it's sitting around 12 times forward earnings, which is sitting pretty much at the March 2020 low. And that gets me a little bit excited about John Deere. But as we talked about, the company is very cyclical. Now, one of the reasons why you should be investing, in my opinion, in John Deere, or if you want to invest in it, or invest in any cyclical stock in general, I would look if they do any kind of stock buybacks, because you want the company to be buying back stock at the bottom of the cycle when the company experiences a multiple contraction, and whenever the market is pessimistic, you want the company to be buying back stock. You don't want a company like Dollar General. Dollar General have leveraged up to buy back stock at the top, but now sitting at the bottom, they have so much debt they can't even buy back stock. So you don't want to be in this situation. You could look at Ulta Beauty, they're buying 5 or 6% of the market cap. I mean, they have pretty much no long-term debt, 300 million of cash, and they just keep buying back stock. This is what you want in these cyclical stocks. And John Deere has the potential to be the same. The company is good in terms of buybacks. They have been doing buybacks steadily pretty much. Now, the way I want to look at it to see if the company can continue buying back stock in this cycle, I would look at the company's own guidance. They have something around 8 to 8.5 in net operating cash flow. I would take the lower number of 8 billion. In terms of CapEx, it's around 1.9 billion. I would take 2 billion, which would give me around $6 billion in terms of free cash flow. Now, $6 billion of free cash flow, the dividend is something like 1.5 billion. So from 6 billion, we take 1.5 billion. So total is around $4.5 billion of free cash flow left over after the dividend. The company does have some debt. They have around 700 million due in 2025. They have some euro debt, around 6 million. So it's around 5 to 600 million dollars a year. So if we take 500 million off the 4.5 billion left after the dividend, we would end up with around $4 billion every single year for the company to be buying back stock, which is around 4% of the market cap for something like John Deere or Deere Company. I keep saying John Deere. So in terms of Deere and Company, the company can do buybacks at the bottom of the cycle whenever the market is pessimistic. This is what you would want if you're looking for some kind of a cyclical stock to invest into. And if we take another look at the balance sheets, they do have a lot of that, like $29 billion. And I'm not sure about the maturities because they are not in here in terms of the quarterly statement. But they did say that the medium-term notes, which are those notes to 29 billion, they pretty much they are due through 2032. So maybe all of them are due in 2032, or they are gradually due in 2032. I'm not sure how it works, but based off how I looked at it here in terms of this chart, and they have some pretty good cash position. So they can, I believe, around 7 or 8 billion of cash. I have to take another look, or you could look at it yourself. But the company can buy back around 3 to 4% of the market cap every single year using the free cash flow after guidance and after the dividends and after paying down some debt, which is pretty interesting for the company, unless they do report another quarter and it's even worse than expected and they revise operating cash flow much lower, then we're in big trouble. But based off this thesis in my video, I think John Deere or Deere & Company is a buy, sitting at 12 times earnings. It doesn't mean it can't go lower. It went as low as 7 times earnings in 2013. Maybe it could happen again, but so far it looks pretty good to me. And this was my opinion on Deere & Company, Best Buy, and AbbVie. If you enjoy these kind of videos, let me know in the comment below. It was not financial advice, but if you did enjoy it, please press the like button and maybe consider subscribing. So I hope to see you in another video.